Investing with a long-term perspective and staying consistent can yield substantial returns. For instance, investors who remained invested in small cap funds for a decade have seen returns as high as 20.66% per annum. But let's be honest, mutual funds don't always guarantee profits. Some funds underperform and investors start wondering, should I hold on or switch to a better performing fund? Switching or transferring investments from one scheme to another within the same mutual fund house seems like a tempting strategy. But does it actually lead to higher returns, or does frequent switching do more harm than good? Let's break it down in this video. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. Many investors jump from one fund to another hoping to maximize profits. They often switch to the latest hot fund or chase past performance. Sounds smart, right? Well, not exactly. Over the last 10 years, the small cap mutual fund category delivered an average return of 16.36% annually. But investors who frequently switched funds based on past winners earned just 14.5%. That's nearly 2% lower returns per year just because they kept switching. Why? Because past performance doesn't guarantee future returns. Funds that performed well last year may not do so next year. So does patience and consistency pay off more than impulsive switching? The numbers say yes. Some investors closely follow market trends and adjust their portfolios accordingly. For example, in 2023 to 2024, small cap stocks boomed, attracting massive investments. But in 2025, large cap stocks took the lead, causing a shift in investor preferences. Many investors keep adjusting their portfolios based on these trends, hoping to ride the next big wave. But here's the catch. Investors who stayed consistently invested in small cap funds over 10 years earned an average of 16.36%. Those who frequently switched based on yearly top performance just 14.5%. Sometimes doing nothing is the best strategy. So frequent switching comes with hidden cost like exit loads. Many mutual funds charge 0.5% to 1% if you exit too soon. And also short-term capital gains tax applies if you switch within a year. And there are also time gaps to consider. The delay between selling and reinvesting can lead to missed gains. So when you factor in taxes and cost, your long-term average return can drop from 16% to just 13%. That's 7 to 8% lower returns just because of unnecessary switching. A study by Axis Mutual Fund revealed a shocking gap between what funds earn and what investors actually take home. A mutual fund return for a 10-year average is 19.1%. Investor returns for a 10-year average is 13.8%. Why the difference? The study, based on 17,000 investors, found that 50% of investors exit within 2 years. Frequent switching leads to lost gains. Emotional investing results in bad decisions. The bottom line, investors lose nearly 5 to 6% of potential returns just because they don't stay invested. So why do investors switch too often? Number one, chasing new fund offers. NFOs, like fund houses, regularly launch new fund offers, attracting investors with fresh opportunities. Many investors dump their existing funds to chase these new offers like NFOs. But here's the truth. Most NFOs aren't necessary. So when should you invest in an NFO? Only if it offers something new like exposure to a unique category or sector not already in your portfolio. Otherwise, switching for novelty's sake is a costly mistake. So should you switch or stay invested? Consider switching if the fund has been underperforming for at least 3+ years, not just a few months. There is a better alternative with a proven long-term track record. The fund has changed its investment strategy and or fund manager significantly. But avoid switching if you're just chasing past performance or reacting to short-term market movement, or you haven't considered the tax and exit load implications. Withdrawing for emergency needs. Many investors redeem their long-term mutual fund investments when faced with urgent financial needs. But is this the right move? Equity mutual funds are designed for long-term wealth creation. Withdrawing prematurely disrupts compounding benefits and can significantly impact your financial growth. A smarter approach, instead of tapping into your long-term investments, allocate a portion of your portfolio to low-risk liquid funds. These funds provide easy access to cash without affecting your equity investments. A pro tip would be always maintain an emergency fund with at least 6 to 12 months worth of expenses. That way, you won't have to redeem high growth investments in times of need. Moving equity profits to debt investments. After seeing small profits in their equity mutual funds, some investors shift their gains to fixed deposits, debt mutual funds, or other fixed income instruments. But is this a wealth building strategy? Not necessarily. Debt investments provide stability but rarely match the long term potential growth of equity funds. While risk management is crucial, shifting funds too early limits your wealth building potential. The better strategy? Stay invested in equity for long term wealth creation and use asset allocation to manage risk. To maximize returns, investors must avoid frequent switching between funds, premature withdrawals, and unnecessary fund shifts. Staying invested in well performing funds with a disciplined long term approach helps bridge the gap between fund returns and actual investor earnings. So, investors who stayed invested for 10 years earn 19.1% returns, while those who frequently switched saw their returns drop to 13.8%. So, what's the key takeaway? Frequent switching may not be the best strategy. Patience and consistency lead to higher returns. A well researched long term investment approach is the smartest path to wealth creation. So, is switching a bad investment strategy? Switching isn't always bad if done for the right reasons. So, when should you switch? If a fund has consistently underperformed for over 3 years, if a fund manager leaves leading to a performance decline, if a better fund aligns with your financial goals and risk profile, if you're nearing your goal and need to shift from high risk equity to low risk debt funds, when should you avoid switching? If you're chasing short term trends or past performance, if you're switching without considering exit loads and taxes, if your fund is underperforming for just a few months, short term volatility is normal. So, important reminders: frequent switching leads to unnecessary cost, exit loads, and short term capital gains tax, ultimately reducing your returns. So, what is the final takeaway? While switching funds can sometimes be beneficial, frequent and impulsive switching often leads to lower returns due to exit loads and transaction costs, short-term capital gains taxes, missed compounding opportunities. Instead of chasing top-performing funds every year, focus on a long-term strategy with strong fundamental funds, patience and consistency, and disciplined investing. In investing, sometimes the best move is simply staying the course. So, do you want expert guidance on building long-term wealth? Then consult a certified financial planner today by registering for a free consultation by clicking the link in the description. And if you like this video, give it a like, share, and subscribe to our YouTube channel. So, thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.